This is exercise 15.5 or assignment 10 in See Now. We're going to be preparing closing entries for this particular company. All right, and so the first place we need to go is to our worksheet, to the income statement column, because the income statement column has all of our temporary accounts that are supposed to be closed in the closing process. Step 1 in the closing process is to locate all the accounts under the income statement column that has a credit balance. Now we're going to ignore income summary. So our 3 accounts with credit balances are sales, purchase returns and allowances, and purchase discounts. Since they have credit balances, in order to close them, we're going to debit the account for their balances. So the first account is sales with a balance of $86,000. The second account is purchase returns and allowances, and it has a credit balance of $2813, so we're going to debit that to close. And purchase discounts is $1,084. Okay, to offset, we need a credit. Remember, every journal entry has to have debits and credits that balance. So we will simply add up these numbers to come up with our credit amount. So $89,897. If we check our work, okay, so everything looks good there. Now the second step in the closing process is to find the accounts with debit balances, then credit them to close. So we have a number of those. So we're going to start off with our debit, though, to income summary. Since we're going to be crediting all these debit accounts, we need income summary debit as our offset. And once we get the total, we will add up all our credits and place it in the income summary debit. Our first account that has a debit balance that needs to be closed is sales returns and allowances, and since it has a debit, we're going to enter it on the credit side. The next account is purchases. It has a debit balance of $54.02, so we're crediting for $54.02. The next account is freight in with a balance of $800, so we're crediting for $800. Wages expense has a debit of $17,080, so we're crediting for that amount. Advertising expense is $784. Supplies expense is $380. Phone expense is $2,100. Utilities expense is $1,310. Insurance expense, we're crediting for $200. Depreciation building gets credited for $4,000. Miscellaneous is credited for $386, and interest expense is credited for $142. Now we need to add up all our credits and place the total in the income summary debit account. So let's see. That should be about $83,222. Okay. All right, so now our debits and credits are closed out. The third entry, you have to be careful on the third entry. This is the most missed entry in the whole chapter. What we're doing with the third entry is closing net income to the capital account. We're not closing capital, we're going to take our net income from the worksheet and close it to capital. So capital gets increased by net income and decreased by net loss, but in this case we've got a net income and we want to increase our capital account. To increase capital, you credit, and we're just going to use the income figure. Okay, and then we're going to close out the balance of income summary, which should be your net income at this point, for $92.65. Okay, and then the last entry is to close drawing. Now we have to jump over briefly to the balance sheet column and pick up the drawing balance. Drawing has a debit, so in order to close it, we're going to credit it. So drawing gets a credit of $8,000, and we're going to close that directly to the capital account, because remember, drawing reduces the amount of capital, so we're going to debit capital to make it go down. Okay, so now it's time to prepare the post-closing trial balance. Now all trial balances come from the general ledger, but we're not posting our closing entries. We're not instructed to. We're not given a general ledger. So we'll just have to kind of figure out what our balance is going to be in our trial balance. And we can just do that by looking at the balance sheet column of our income statement. The balance sheet column of our worksheet. Okay, so let's pull up the post-closing trial balance. Okay, remember the post-closing trial balance is made up of all the permanent accounts or the balance sheet accounts. So we'll start out at the top of the balance sheet and enter cash, and then accounts receivable, and then inventory, supplies, prepaid insurance, the building, the accumulated depreciation for the building, accounts payable, wages payable, sales tax payable, and then we're going to enter our capital balance. You have to be careful here because the capital balance is not what's shown on the worksheet. This capital has to be updated. Okay, so let's think about what we did in our closing entries. We added net income and subtracted drawing. So we're going to take our beginning balance there, $87,883. We're going to add the net income figure to it of $92.65, and then we're going to subtract the drawing amount, which will give us a balance in capital of $89,148. Okay, so let's add these up. And we get $112,634, and we'll put that in just to see if that happens to be our balance over there as well. Check our work, and so our post-closing trial balance is in balance, so we could go on to the next year knowing that our books are ready to go. The next assignment that we'll look at is exercise 15-6 or assignment number 11, and it just deals with reversing entries. It'll be a very quick one. So remember the rule for reversing entries. We're looking for adjusting entries that take an asset or a liability account from a zero balance to a balance. So we're going to take a look at our adjustments. Here's our adjustments. And so we know that merchandise inventory already had a balance. All we did was adjust it. Supplies already had a balance. Prepaid insurance had a balance. Accumulated depreciation, remember we just never reversed the depreciation entries. And here's wages payable. Wages payable is a liability. It had no balance. We gave it a $280 balance. So we know that that is an entry that we should reverse. So to do that, we just debit wages payable because in our adjustment we credited it. And then we're going to debit wages expense because we're going to credit wages expense because in our adjustment we had debited it. So our reversing entry will be debit wages payable, credit wages expense for the $280 we had in the adjusting entry.